on the cloud.
Awesome.
This
Okay.
meeting is being recorded.
So this is my first time being on this Marketing Matters call, and so I'm gonna open the floor as we go through some of the slides. If you guys see stuff that interests you, feel free to, like Sarah said, put some stuff in the Q&A. Happy to dive into whatever kind of reaches out to you guys. So some of the topics we're going to cover is just kind of where the market's at. Today is actually a really big day in the market because the Feds are going to be deciding whether or not they're increasing the rates or if they're going to increase it by a little bit less. Right now, it's trending like they're going to still do the 75 bips increase, which we've already priced into the rates. So we'll see that here in the next few hours. And then I'm going to move into some of the trends that we've seen over the last few years, and then move into talking through what the loan limits look like for next year, and then how we're supposed to, price strategize for the future, and how, now that this market's become a little bit more of a buyer's market, how we can get a competitive advantage with our buyers to make sure that they don't feel pressure at the 7% range, but at a 5%, a 2% reduction, they can make that payment work. So the goal of this call is to go over a lot of that different strategies for that, and then we will finish up with an overview of the 2-1 buy down, and then some other products and things to kind of go the extra mile for our clients. So first, I wanted to start off with where the rates are at today. So I'm a mortgage broker, so rates are a little bit lower than the normal traditional big banks that you might have used in the past. So if you take a look at this slide, it just goes to show you that, and you'll get a copy of this, I'm sure, but it shows you just where the rates are at tentatively. About 2-3 weeks ago, we saw them start to approach and get above 7. And they've come back a little bit as we've expected that some of the rates are going to, as inflation's starting to curb, they're starting to slow down the increase in rates. So this was done actually just an hour ago, just to give you live rates of where things are at. And as you can see, we're actually in the mid 6s, which is pretty awesome. And then the VA is actually getting close down to the low 6. So rates are, actually doing pretty good right now. And then this slide just goes to show you, we've had some huge changes in the rates from 2020 when we had the good days of the 3% interest rates. And I still remember flowing into 2022, a lot of my buyers, and I actually had 10 buyers going into 2022 that they went from a 3% potential interest rate all the way up to a 4.5 by the time they finally closed. So it's definitely been a big hurdle for everyone, and hopefully good times ahead with potential rates to drop sometime next year. And we'll talk about that a little bit here in the next few slides. One of the other big things I wanted to highlight, as many of you are already aware, the loan limits for 2023 have been increased, and so 2022 limits are showing as these numbers, but these are actually for next year. But because banks can already forecast that these are what the loan limits will be, they're already accepting it, as I'm sure a lot of you have already submitted contracts. And the benefit of this, like with the increase in the conventional loan limit, is the fact that you're able to not be in the jumbo territory, which gives you better interest rates and just helps buyers qualify. A big thing that's been commonly discussed lately is seller concessions. I actually just recently had a contract where the realtor put 4% concessions on a conventional deal, but we were only putting 5% down. And so we actually had to renegotiate the deal because there are limits on seller concessions that all realtors need to pay attention to, because it could jeopardize a deal if you accidentally put too much concessions and then they go wasted. So this is just an important, I'm not going to go over each specific line item, but it's a very important slide to take notice to, that oh, sorry, lost my slide. It's a very good slide to take notice to, that, if you're doing a conventional 5% down, we're only going to be able to get 3% in closing costs. So just something to keep in mind as you're starting to see a lot of seller concessions come into the picture with every single offer that's going out now. And this will help your buyers, with closing costs, as well as the temporary rate buy down that we'll discuss in the last few slides. So I'm going to pause before we start talking about the 2-1 buy down, and just give an opportunity to see if there's anybody that has questions on some of the concessions or any of the first few slides that we briefly discussed. And if not, that's fine, because a lot of it was just highlights from the past year or two, and as well as just where we currently are at.
I don't see anybody, Mark. I don't see any
Okay, I'll keep moving on. Hopefully there'll be some questions once we start diving into some of the cool other products and ways to, win some buyers over. So
yeah, great.
So the 2-1 buy down, I've had multiple realtors that I've worked with that I've sent out some of these marketing material, as you can see on the slides. I've sent out some of these marketing materials with realtors and to buyers that were like, hey, I'm on the fence, I want to wait, or hey, the rates are just way too high, I can't buy something at 7%. And a lot of these materials have actually materialized new buyers. So we've gone from having 20 borrowers sitting on the sideline to 10 new contracts in the last last month alone. So if you guys aren't pushing the buy downs on your clients, that is one of the biggest assets that you should be utilizing, because it moves a monthly payment from, let's say, I just did another borrower yesterday where they were comfortable around a $2,000 a month payment. Well, at a $400,000 purchase price, that was looking at closer to a $2,500 a month payment. Once we initiated the 2-1 buy down, their first year was going to be just slightly below 2,000, and then the second year was going to be in between, and then the final year was going to be at the 2,500. But what we communicated to the borrower was, hey, over the next few years, you are projected to make more income, get raises, and make more money. But then in the next few years, we are bullish that the rates will come down. And so what that meant was, hey, we'll be able to refinance in the next year or two. And so that really opened the door to a lot of new buyers that flooded into the market. And so if you aren't pushing this, this has been a big asset for anybody that has buyers that don't want to buy because the rates are too high. So happy to discuss a little bit more about this. I have a few other slides that kind of go over the 2-1, but this is a huge benefit to buyers because it allows them to have temporarily a lower cost barrier to entry. The one thing to keep in mind is this rate, the 2% drop, we don't get to qualify off that. We actually still have to qualify off the full term rate. So if your starting rate's a 7 and your first year is a 5 and then a 6 and then a 7, you still have to qualify at the 7% interest rate. But the point being is, or the big takeaway is, that borrowers like the thought of a lower first and second year, because that allows them to get comfortable with the rate, and then they can decide, hey, do we sell after 2 years or do we refi? What's your options at that point? But it opens the door to a lot of conversations of, how does this look? So if any of you guys need flyers like this and want me to co-brand it with you, I'm happy to send you some of this stuff, and you can send it out to your clients and hopefully get some new buyers in the pipeline. So when you guys get these slides, you'll be able to actually get the link that is included in this. If is a direct link that helps you calculate what the buy down would look like, what the monthly payment's going to look like. And it's a pretty neat tool that just shows the buyers and how much concessions you'll need. But this is a pretty good description or picture that shows what it really looks like to a buyer, kind of like the scenario I just told you. So full term rate is 6.75 for this given scenario. And so for this given scenario, the monthly payment is $24.65. But if we do the 2-year buy down, their first year is a 4.75, which that equates to $19.85. So this is actually almost the exact same scenario I was referring to the slide before. And I just happened to have the same situation happen to me yesterday. So as you can see, the first year, every single month, you're going to save almost $500 a month. And that in turn equivalates to a $5,700, $5,800 yearly savings year one. And that is not just in savings on that, but you're also going to save year two. It's just going to be 1% higher, but you're still ultimately saving on the buy down. The really neat thing about this buy down program and why it's pushed more than a permanent buy down, that's been a lot of the questions. Well, why don't I just permanently buy down my rate? And the reason why is if your rate today is a 6.75 and you want to buy down to a 5.75, that's going to cost you upwards of $10,000+. The other factor to that is if you go to refinance in the next 2 years, 3 years, your return on that investment on that buy down is normally about a 5 to 7 return on the investment. You know, if you spend $10,000, you're only going to save about, you know, a couple of thousand every month or every year, which then equates to it's a 5 to 7 year return. Whereas when you do the buy down, you're saving from day one, and anything you don't use. So let's say we refi after year one. So we've exhausted this $57.92 and saved that much money. Well, after year one and we refi because rates are down at 5%, you're going to actually get $3,000 for your buyers to put towards their principal. So they don't lose the money. Whereas with a permanent buy down, they actually lose the money. So that's a big takeaway. A lot of the permanent buy downs end up going to waste if there truly is going to be a refinance opportunity. Now, back when the rates were 2.5%, 3%, the buy down didn't make sense because the rates were as low as you were going to really ever see them. But in these moments where rates are projected to be lower because, you know, we can't be operating in the 10 to 12% range at these home prices and the build costs and the supply costs, so rates will have to adjust. And so that's why we're predicting, and that's why I've been posting a lot of content on YouTube and Instagram that talks about the micro and macroeconomics of why rates will come down. And this sort of education is what your clients pay you for. They want to know your expertise and understanding that why the rates will come back down, and actually being able to explain, hey, this is why, because of inflation being curved and things like that, will really set you apart from a lot of other realtors. So that is a huge factor in understanding where rates are headed, trying to help navigate that conversation with your clients so that they feel comfortable. Hey, you're buying, you're loving the home, not the rate, because we're going to hopefully refinance in the next few years. So the next topic I'm going to cover is DPAs. So I want to just take a step back and just see if there is any questions on the buy down, questions about just anything that we've discussed.
I don't see anything yet, Mark. I think you're doing an awesome job. Buy downs are definitely a hot topic right now. I'm so glad we're covering them.
Yeah, it's been pretty awesome. The last 10 contracts in the last month or so have all been with 2-1 buy downs, and it's really allowed all of my buyers to feel comfortable with that first year rate. So it's definitely been a huge benefit to clients. So
awesome.
I'll just move into the DPAs and then go from there. So DPAs is another hot topic that I feel a lot of lenders and loan officers have said, oh, they don't have DPAs anymore. Oh, a lot of loan officers just don't want to do them. However, I've taken the step and said, I'm okay with doing the DPAs. Yes, they are a little bit more work. Yes, they take a lot more to get them qualified, but I've gotten to the point where I've understood how to make sure that we don't have delays. And so this is just an example of where the rates are at for a DPA so that you can understand if it's right for your clients and if you want to push it. So before I dive into the rates, I just want to talk about DPAs as a whole. In my opinion, there's always a give and take. If you go get a DPA, there's going to be a reason why they're giving you free money. They're going to give you a higher interest rate to recoup the money that they're giving you. So in a way, if you have money for a down payment, even a small 3% down, you are always going to benefit from having no DPA over a DPA. But if it's a make or break where your client can't afford to buy a house otherwise, then yes, I always advocate, let's at least try to make them fit into the DPA box rather than losing out on a deal. Here's a perfect example though of where the pricing is at currently with the DPA as of 10/27. So as you can see right now, the cost for a DPA for par, where you're not paying any points on it, would be right in between the 6.875 and 7%. And then there's some other DPA factors like your FICO scores. Is it a, cash out, no FICO scores, all the different things that impact the rates. But starting rate is a 6.875 to a 7%. And then there's also, the closing costs, but you'll get those covered from the seller, hopefully within the negotiations. But the DPAs work just like any other deal. The only difference is you're going to have to get the closing costs covered by the seller if the buyer can't afford it. Now, the closing costs are a little bit higher because of them being a DPA, but at least you still have the 3.5% coverage by the actual bank that's going to be covering the DPA. So it's a great option if you have clients that have no money whatsoever or just enough money for closing costs that want to buy a house that just haven't been able to save money up for the actual down payment. But I've been doing these for the last few years. It's just when rates were so low, if you had done a DPA, some of the DPAs you're tied in for 5 years, some of them you're tied in for 10, 3. There's different stipulations per DPA and whatever fits the box. So every different scenario changes. Oh, okay, there's 5 different DPA providers. This is where the best situation is to send this one. So the biggest takeaway with DPAs is it's there for your clients if they need it. And I'm happy to go over those options with them if they're potentially a person that might need a DPA. All right, so the next part of the last few slides that I have, I just wanted to, for this slide, I wanted to cover just some of the non-traditional products that a lot of realtors don't have a ton of experience in or just don't have familiarity with it, so that you're introduced to it and know that you have it as a resource. I know a lot of you might already have loan officers you work with. They just might not pitch this, or they might not even offer it, depending on if you're working with a direct bank or a bigger like a credit union, for instance. Some of them just don't have these options, and so I want to make sure you understand that there is outlets for some of these different programs. So first thing is bank statement loans. So for any of you that have a lot of self-employed borrowers that don't show the numbers that they're making a ton of money on their taxes, bank statement options are the best way for them to go buy, because all we do is take a look at all their bank statements for the last 24 months, and we do a standard expense ratio, and then we could actually even reduce that with a CPA letter. But the big takeaway with bank statement loans is if you have a borrower that has a lot of income going into their bank accounts, we can use that bank account to show their availability to purchase. And then similarly enough with a bank statement, we also can do asset as depletion. So for any of you of those that have people that have a lot of money but don't make a ton of income on a yearly basis, if let's say they have $4 million in asset accounts, you can actually use that and project what they can have. And so someone that has a $3 million asset account can actually utilize anywhere from $7,000 to $8,000 per month for buying power, which is very huge for those buyers that might be older and don't have standard income coming in, but they have a huge asset account. So that's a good one to keep in mind. The next one would be DSCR. So DSCR is investor only specifically. So if you have an investor that doesn't have a way to show their income, or they just have a lot of properties, so they just want to go based off of the specific property, it looks at what is the rent coming in on that property and what's the mortgage. As long as the ratios meet, no issue with buying. The rates are slightly higher, but for an investor that just wants to get into homes and buy a bunch of inventory, that is the best route to buy a lot of investment homes. The next one on the list is the 6-month ARM. So the 6-month ARM is not offered by a lot of loan officers, not offered by the traditional banks. It basically every 6 months your interest rate adjusts. Because of that risk, the rate is actually anywhere from 1% to 3% lower as a starting rate. For instance, I just closed on a deal a month and a half ago where the starting rate was 3%. And there's a lot more to just the 6-month ARM that I'm going to go over in this call, but the big takeaway is the rate was 3% when the investment rate was sitting at 6%. So as you can see, there's a big difference between the rate, and getting a 3% interest rate a month and a half ago, 2 months ago, was huge for a lot of my buyers because they were able to then get into homes that would pencil out even with their max rate going up to 5% from the starting rate. So if you have any interest or know any investors that would potentially be appealed to the lower interest rate options and they're pushed out right now because the rates for investors at 7.5%, that's something I'd love to talk more about and go into. And then the last two things that I'll briefly touch on is the no FICO scores and the foreign buyers. So I've had a lot of realtors reach out to me over the last few years about, hey, what are your products for people that don't have FICO scores and foreign buyers? And a lot of places just don't have those outlets. But if you have a buyer that doesn't have FICO scores and we can't get them a traditional FICO, we do have outlets. The rates are a tiny bit higher because there's an added risk, but they still can get into a home. They can still start building equity, which is the big selling point. Rather than paying to interest every month on a rental property, they can actually get into a home. And same with foreign buyers. So those are two loan products that not a lot of people push or even talk about, but I have the ability to offer them. So a lot of other loan officers still can. And if they haven't, educated you on those, I can get you more information to kind of delve into what those are all about. Now, the last slide I wanted to cover as like a takeaway, and before we go into any questions, if there is any, we're just how to stay competitive and relevant. Obviously, the 2-1 buy down, understanding products, knowing what you can provide for your clients is step number 1. But then having some of those non-traditional, uncommon things to offer your clients is just that extra selling point that makes them feel you are earning their business, that they want to work with you because you not only are just showing them homes, you understand the market. You understand what you need to provide to give them the full experience. And that's kind of what I try to do with my business and what I try to do with my realtors, and always keep them informed with weekly updates, with monthly shares of what new products are coming out, how I can help. And number 1 is hard money loans. So a lot of places don't offer hard money loans. They offer it in the terms of like a bridge loan. But I, at Price Mortgage, am able to offer hard money loans for any of the buyers if they're trying to buy something before selling, if they're, if they've bought and they're just past clients and they need access to cash in the terms of a HELOC, but they can't qualify. those kind of things that your clients have access to, just keep them in the pipeline, keep them feeling like, wow, it's a full service. They have options to be able to go and get money when they need it. And having that as an outlet to your clients is actually beneficial and will lead to more repeated business. The next thing I will talk about is Home IQ. So it's similar to HomeBot. If you've heard of HomeBot, it's identical to HomeBot. And what it does is every time I close a deal, you're automatically tagged with the house that they purchased, and then it sends them monthly newsletters that just say, hey, here's where your house is at, here's how much it's worth, all the different information that a client wants to know. But then the other big takeaway is that as the rates drop, it actually alerts them, hey, you should refi. And then it lets them know how much equity they have, all these different benefits that then is tied to you as the realtor. And we co-brand that so that when they go to sell or when they go to do something, they have the constant emails to stay relevant. And if you look at some of the statistics that show Home IQ and HomeBot and these kind of CRMs that constantly alert them of what their home is worth and different important things like that, truly capture a lot of repeat business. It's an upwards of 50% or more of what kind of recapture you get from having these tools that continue to inform them of what their worth is and remind them and keep you in the front of their mind so that when their friends are buying, they remember, oh yeah, you should use my realtor. And so that's a huge one. And then the last two things I'll talk about is Airbnb for clients. So one thing that I do that I help and allow all of my realtors to have access to is I have a few Airbnbs and a few rental properties, as well as some of my investors, that we allow clients to use while they're house hunting. And the reason why that's so critical, and at least a couple of years ago when the market was so intense, is because it gets very expensive when you're looking for a home for 1 or 2 months. And not having that sort of access really can jeopardize, oh, I think I'm just going to rent. So having these kind of accesses to short-term accommodations as they're looking really is a selling point to a lot of buyers, because they think, oh, wow, I don't have to go drop $4,000 a month to go stay at an Airbnb. So anybody that has buyers that potentially need something like that, that is always an option for any of my realtors that I do business with. And the last thing that you guys need to continue doing, if you're not doing it, you should, is past customer engagement. So some of the things I do is I have Cardinals season tickets. I have all these different things that I try to do as giveaways, swag, and things as closing gifts, as just gentle reminders of thank you for the business and just to stay relevant. You know, just a few weeks ago, I gave away Cardinals tickets as a giveaway, and I had 100 of my past clients reach out to me either saying thanks for the chance to get in the giveaway, to, hey, I actually have someone moving into town. I'm going to connect you with them to see if they want to buy. So it just continues that conversation. And any of my realtors that are tied to each one of the specific clients, they get roped into it as well. So if I've done business with you and we closed a deal and that person's referring us, you get roped in immediately. And so some of those buyers that wrote me after I sent out that giveaway, it was just that immediate traction that I got from my past clients. So anyone that has past clients that aren't dripping on them, that aren't engaging with those clients, you really are not selling yourself, because those are your best assets. They're the ones that had an experience with you, that love the experience, and they're the ones that you need to get them to go tell their friends, hey, this is an awesome realtor, you need to go use them. So for anyone that wants more on that, I'm happy to talk offline and share some of the other things I do to help my retention of my past clients. But with that being said, that reaches the end of my presentation. And if there's any questions, I'm happy to go over them. Otherwise, I'm you see my contact information below. You can message me, you can email me, however you guys want to get a hold of me. But I am happy to talk anything related to the real estate industry.
Awesome, Mark. That was a lot of really good information today. If anybody has any questions, please put them in the question and answer or the chat window. I think you covered things incredibly well. Mark's info is up there. Mark, could you also please, for their convenience, put your information in the chat window in case they want to just copy and paste it. We're going to wrap up today with other classes that we have coming on. So if you guys want to stick around for a few more minutes.
Thank you, everybody.
All right, I got kicked off again, of course. It's just one of those days, guys. Just one of those days. All right. Going through the last couple of things that we have coming up, hopefully, maybe. All right. My screen, of course, went blank again. It is not liking me screen sharing today. Okay. All right, guys. I am going to try one more time. If not, if you guys need a copy, we have a bunch of CE classes and whatnot coming up. So if I do not get the opportunity to share it, that will be okay. We also have market insights. I don't know if you guys can see, or if it's just me talking to myself on here. But we'll go ahead and we'll just wrap up with the last couple of things that we have coming up. We've got market insights tomorrow at 9:30. If you guys want to hop on that, this is always a great webinar, great information. And then we've got a couple of CE classes coming up. We've got the AAR pre-qualification. This is going to be tomorrow as well. If you need some contract law credits, this is 9:30 till, or excuse me, 9 until noon tomorrow. And this is in person at the Holiday Inn Conference Room. And then we've got the code word ethics. This is going to be on November 9th. That's next Wednesday. This is at 9 a.m. to 12. Yeah, and then Melinda says this is showing up, but my face is gone. For whatever reason, I don't know. I'll restart my computer. You guys can hear me though, and that's good. This is Code of Ethics, and this one is going to, oh, excuse me, Commissioner Standards. This is a Commissioner Standard and NAR Ethics, which I think actually you can get credit for Commissioner Standards or Ethics with this particular type of class. So this is going to be an Eventbrite. If you'd like to attend, let us know. This is online as well. And then we've got Home Select Loan Tool. This is also going to be November 9th. This is from 1 until 2:30. So if you'd like to learn a little bit more about some really cool tools, let us know. We'll get you registered for that one as well. And then we've got our Prescott office doing they are wrapping up their landmark tours. You guys have heard about landmark tours for quite some time because I promote them on here all the time. They're wrapping up next Wednesday with their last one, the History of Whiskey Row. And then they're going to be doing a little after party at Jersey Lily Saloon. We're going to be doing GIFs there as well. Those are the little moving headshots. So come up, check it out, be a part of it. And then next Thursday, Melinda is hosting a Boots and Bourbon social media photo shoot. You guys, I have seen some of the demos from this, and they are breathtaking. They are amazing. This is going to be Thursday, November 10th from 1 until 4 p.m. They're going to be 4 different backgrounds, each of them $25. If you'd like to attend, please RSVP to Melinda for that. And then November 16th, Patty and Michael are hosting a VA FHA reverse mortgage for purchase class. This is a CE class. It's going to give you 3 hours of legal issues from 9 until noon. And this one's going to be at Arrowhead. So if you'd like to attend that, let us know. And then if you need your fair housing credits, we've got That's Not Fair. This is coming up on Thursday, November 17th. It's part of our third Thursday Zoom CE series. So if you'd like to attend that one is 10 until 1 p.m. And Mike and Sally are teaching it, and they are a blast. And then last but certainly not least, moving into December with the Introduction to Divorce Real Estate. This is 3 hours of legal issues hosted by Patty and Michael. And this one is going to be in person as well at the Holiday Inn Conference Center. If you'd like to attend, let us know. That's it for us today, guys. Of course, thank you to Mark for coming on. That was a great presentation. A lot of really good information. He put his information in the chat window if you guys want to get it. If you have any extra questions, I know a lot of times people are nervous about asking questions on a live presentation, but that's why you've got his contact information. Of course, thank you to our fabulous business development managers. Reach out to them for anything that you need. And thank you, of course, to Landmark Title for allowing us to bring you Marketing Matters. If you haven't done business with us yet, we would love the opportunity to do business with you. We have 7 offices across the valley, as well as one in Prescott. So please think of us on your next contract when you are out there busy doing the 2-to-1 buy downs with your buyers and you're getting a ton of buyers. We'd love to work with you. And then, of course, thank you to our partners. We've got Homestead Title, Capital Title, and US Title. These are our nationwide partners. Yes, Landmark Title may only be here in Arizona, but we have national partners to partner with. So if you're doing any deals out of state, let us know. We'll hook you up with the right people. And that's it for us today, guys. Thank you guys so much. Sorry for a few of the weird technical things. You know, we're up at almost 100 episodes on Marketing Matters, and every once in a while we get thrown a curveball, but we got it. We got the information. The recording will be available. If you would like it, let us know. I hope you guys all have a wonderful Wednesday, and we'll see you tomorrow morning at 9:30 on our webinars for Market Insights. Have a great day, guys.